The investors are powering through all these concerns about the jobs market, about sequestration, and they're lifting the markets up. What do you think is going on?
Very, very low interest rates. Money is extraordinarily cheap, and we're in the process of creating a whole series of bubbles. Roger just talked about a deal flow and terms of the deal, which is even more relevant. Money is being available for a whole host of investment opportunities or merger opportunities as well, at very low cost and with very good terms for the borrower. When interest rates go up, and interest rates will have to go up at some point, there will be a rash of failures. A lot of those deals will simply come apart because interest rates will not continue at essentially zero.
Well, I mean, but it's not as if once interest rates go up, those deals, though, unless you're talking about deals that are based on, floating interest rates, deals. I mean, then, those deals are in place with the fixed interest rate or the fixed rate.
No, many of them are not. Most of them are not. For banks to do fixed interest rates over any kind of long term is not going on. Companies can raise bonds at relatively low interest rates, but they can't get term loans with long tenures at reasonable fixed rates. So if you have a 3-year tenure, that's a fixed rate loan. In 3 years, that'll reset.
But why are you convinced, though? Because it makes it sound like you're saying that when interest rates go up, it's going to be very disruptive. Why are you not convinced that Ben Bernanke and the Fed can raise interest rates in a more orderly way?
They can until they can't. Our debt is going up by $1 trillion a year. Under almost any scenario that you could imagine with current growth levels, that debt limit is going to double in the next decade. And that eventually the markets will not buy those bonds at the current prices. Eventually. I don't know when it'll happen. But Bernanke cannot keep printing money forever.
Well, speaking about Bernanke, let me just play for you quickly a soundbite from the testimony Ben Bernanke gave on the Hill yesterday, where he talked about bubbles in the economy.
Okay. Well,
I don't see much evidence of an equity bubble. Earnings are very high. As I said, the equity risk premium is above normal. And that is, in other words, pricing is, equity holders are still being somewhat risk averse in their behavior.
So Bernanke doesn't see an equity bubble.
Right.
You do. What's he missing here?
No, I see a whole series of bubbles, not necessarily in the equity markets.
Okay.
There are bubbles being created as money is pouring into sectors where people are responding to low interest rates by either going out on the risk curve or going out on the tenure curve. Both of those are causing asset bubbles of different kinds around the world that will be negatively affected when interest rates go up.